Yeah. Yeah.
Good afternoon, everyone. Thank you so much for joining us on our Lunch and Learn webinar today. We will be doing these webinars at the end of each month on timely topics. And today, we will be going for about 15 to 20 minutes. Graham will be speaking, and at the end, we'll be doing a Q&A for 5 to 10 minutes as well at the end. So if you have a question during the webinar, please go to the chat box and type in the Q&A section and type your question there, and we'll read it off at the end if we can get to all of them. So if we look forward to having you on these calls in the future, and I'm going to turn the call over to Graham Wickham.
Thank you, Jeremy. If I could, in your chat section, can you let me know how we sound and how I look? Hopefully I look very young, very in shape, but if you could just take a minute and just type out how we sound and how we look today. We're working a little bit more remote, unfortunately, with the storm, and I hope everyone out there is safe and healthy wherever you're at. But I know the storm that passed through here last night and early morning has interrupted our Wi-Fi at our office. So I'm carrying this call out from my house. So a little bit different for all of us. But again, I hope everyone's doing real well. I've seen a couple popping through, all good. Visually and audio, does that still sound good? You can type in that chat section. Okay. When we get over to, thank you. When we get over to the question and answers at the end, that's where you'll go under the Q&A section instead of the chat when it comes to asking those questions. Thank you all for your response. Let's go ahead and jump in to the call. I'm going to try to take this off my screen here, if I can do that without messing everything up. Let's talk a little bit about tax tips as we're leading into the end of the year. And I think we highlighted 8 different tax tips for the end of the year. Again, I would always advise you, please reach out to whoever you work with, your CPA, your bookkeeper, your tax attorney, whoever it is for you. They're going to be the best resource to confirm what's best for you. But these are just good little considerations, and I think very timely for the environment that we're in right now. So let's think about maybe how we can defer income. So deferring some income, if you own your own business, we might want to think about billing out in December. You probably already do this. If you don't, you might want to think about billing out late December, so it shows up as a bill that goes out in December, but you're not going to be collecting that income until the first of the year. You also might want to think about receiving your largest paycheck if you're planning to retire, your largest paycheck in a year that you haven't earned all your income. And this has come up with some clients, and it could be just a very timely time to think about this, is that if you've worked all year long and you've had that earned income, you're probably right in your peak earning years. Maybe think about getting your last check in 2021 or January or February of 2021, so it won't be taxed when you have all this income this year. And delay taking Social Security benefits basically in 2021, maybe the first part, instead of taking it this year based on all the earned income that you've had. Some other last minute deductions. When we think about it from that way, let's think about charitable deductions. Always a great area. Let's think about highly appreciated assets. If you have some of those great tech stocks that have done so well, maybe we think about donating those tech stocks or some of the position to a charity. The benefit there, you get the write-off for the deduction to the charity, as well as you just don't have to pay capital gains. So that can be a little bit of a double benefit for you. But we want to be careful here with the alternative minimum tax. It's basically came about for wealthy people not to or not have the ability or all the ability to take legal deductions and avoid some taxes. So basically, if you're getting into the alternative minimum tax area, I'll let your CPA or tax attorney get into more details with you on that. We want to be careful and just be aware that you'd be backing yourself into that with some of those deductions. I think this is pretty important. Let's think about selling investments to offset gains. This year has done surprisingly well outside of the last couple of days, and we just got to expect this volatility, right? If we think about it, besides the last couple of days, the Standard & Poor's index, the stock market, 500 stocks was up 7%. We had the NASDAQ was up over 20%. I mean, who would have thought we would have had such great markets in some stocks that are up 300%, 400%, 100%, 20%, 60%, really some great gains in some sectors. So maybe you offset some of your gains with some of your losses. And let's go into that a little bit more. So basically what you can do in your taxable accounts, you can go in and say, hey, listen, not that these stocks won't do well or better over time. Maybe some of the cyclical names that have been out of favor, some of the value things that we'll talk about in a minute, maybe they've underperformed or they haven't had their day in the sun yet. Maybe you go ahead and sell them, right? You'll offset your gains that maybe you have or should take or consider taking on some of the tech stocks that have done so well, or anything that's done so well with the stay-at-home trade or the COVID positive trade. Whatever gains you've gotten there or on your mutual funds, keep that in mind. In your taxable accounts, your mutual funds may likely, if they're growth funds, very likely are going to be issuing large capital gains or capital gains. Take those losses to offset those gains. If you wait 31 days, you can buy that back. But think about it this way. You can also just buy maybe an ETF or a mutual fund in that same sector, because rarely does a stock outperform its sector. I'm not going to say that doesn't happen, but it's really hard for one particular stock to really outperforming a sector that's out of favor. So hopefully that makes sense. We can follow up with you individually. So as we're going through the webinar, my calendar is going to pop up. Don't hesitate to hit that calendar. Let me know if you want me to give you a call. Any of my team members give you a call. Let's go over your personal situation again. If something's changed and we haven't had a chance to talk about it, hit my calendar. Let me know when time's good for you, and I'll reach out and we'll have that conversation. All right. Let's think about contributing the maximum to your retirement plans. So in a 401k plan, this year you can contribute $19,500. If you're over 50 years old in the 401k, you can contribute $26,000. But if you're not contributing to the 401k, you could be contributing to an IRA account. So in an IRA, your deduction under 50 would be allowable up to $6,000. If you're over 50, add $1,000, that's $7,000. It's called a catch-up provision where you can contribute to the retirement account. Doesn't mean you still can't contribute to your retirement account even if you're funding a 401k, but just keep in mind, it might not be deductible on taxes. You may get some tax deferral from that, but also keep really good records, because at time of distribution, if you don't get the deduction for your contributions to your IRA, at time of distribution, you want to say, hey, listen, there is a portion that I got a deduction on. There's a portion I didn't get a deduction on, because all money leaving in an IRA is going to come out and be taxed as income. Let's look at avoiding kiddie tax. So what is kiddie tax? Well, it's basically earned income above $2,200, all right? So where the mother and father might try to shift some of that earned income on appreciated assets over to the child's tax rate, which inherently is lower, correct? Well, be careful with that because they thought that through. We just want to be careful that you don't and you try to avoid the kiddie tax, because the tax on kiddie tax is around the trust and estate tax level. The average income level out there is around 17% average. Probably many on this call, your tax rate is 25, 30+%, since a little bit higher tax rates. But the estate and trust tax rate is roughly around 40%, so quite a bit higher. So we want to think about avoiding the kiddie tax. And again, these should be conversations that you're having with your trusted advisor from a tax standpoint. They should be having these conversations. If you have a financial advisor and your attorney, all three of those components, you can throw your insurance agent in there. They should all be a part of your wealth management team, talking to you about all these different things as we're approaching the end of the year. Let's think about check your IRA distributions. This year you didn't have to take RMD distributions. So if you took an RMD, you had time to back, you had time to put it back in, or you didn't have to take that RMD distribution. But they also pushed out when you have to take your RMD distribution. It used to be 70 and a half. It's now 72. But keep in mind, you have to take that out by December 31st. If you don't, there's a 50% penalty on the amount that you should have taken out. And we certainly don't want to pay 50% in a penalty to the IRS, the government. So let's watch your flexible spending accounts. Maybe some of you that are working for corporations have that flexible spending account. That's basically an amount that you can set aside for qualified expenses, medical expenses. Generally, let's think about them as co-pays and your deductible. It doesn't cover for your insurance cost per se, but just some of those costs to going to see the doctor, maybe some drug costs. And it's kind of one of those that's a use it or lose it. So we want to make sure that you use it by the end of the year. Maybe you go get that last minute dental checkup or filling or crown or goodness, I hope you don't have to get any of those. Those are no fun. But just going to see your doctor and using those funds. Your employer may allow $500 to carry into the next year, or they may allow you to use those benefits for another 2.5 months that would stretch into the new year. So just keep in mind, it's a use it or lose it plan, but your employer has the discretion to allow it to move over to 2.5 more months into the new year or carry over $500. So just make sure that you're aware of that when we're looking at the plans. So that kind of wraps up the 8 tips. There's certainly so many more we're happy to have a conversation with you about as we're going into the end of the year. But like I said, this has been I feel like I'm speaking to the choir here, and I know I am. It's been a very unique year, and it's certainly wrapping up to even be more unique as we're moving into the election. And since we've had really solid gains in the markets, if you've been in that COVID positive or the tech trade or anything that's worked with stay at home, you've done really well. So that kind of leads us right into growth versus value. This is really, you're here on TV, you're probably thought about it. I know we've talked about it with you on a regular basis. And think about it this way: growth and value are two fundamental approaches. There are different styles. All right. They're not one and the same. And that would apply to stocks and stock mutual funds. So let's define what growth is and what value is. Some characteristics of growth. So anything that I keep throwing at there, co-positive, things that have allowed us to be at home, facilitate our productivity at home, they've done really well, right? So they are going to be higher priced in the broader market. If you look at some of the multiples in the tech industry, the IPOs that have recently come out, heck, UPS, FedEx, Home Depot, and Lowe's, I think we reasonably have to say that those valuations are certainly not inexpensive, and they're priced to perfection, right? And we've been seeing some earnings coming out for companies, but what happens? We've had 85% of the companies that have reported earnings positive and have beaten by 20%. That is absolutely mind-boggling in the environment that we're in, which is great. Imagine if we weren't in a pandemic, what this might look like. But I think some of the trades, some of the valuations have been pushed forward because I think technology has been pushed forward for us. What might have been 3-5 years down the road in terms of working from home and having that productivity, I think is here to stay in a large degree. But getting back to growth, they're higher priced, broader market value than the broader market in terms of valuations, the price to earnings multiple. They generally have higher earnings and a higher growth record, and they tend to be more volatile than the broader market. Think about it. There might be newer or younger companies when we think about growth. When we think about value, the best way I can think about value is think about it from underloved, underappreciated investments. It doesn't mean that they're not going to do well for you over time, but they might not be sexy, or their industry, their sector, say it's financials. Heck, let's say it's industrials all the way to energy. There's certain sectors that have just not done well at all, but it doesn't mean they're not going to do well later. They're just not doing well now. They're not the in vogue trade. That's not where the earnings are right now. But think about it this way. There are times when value outperforms growth, and we'll look at that in a second. So we want to think about what is value is lower priced than the broader market. Maybe their multiples, the price to earnings multiples are lower than the market. We have a price to earnings multiple right now on average in the market of roughly, let's just say about 25. I think that's pretty close. And remember from the last Lunch and Learn, most bull markets in history have started at a multiple price to earnings multiple in the market of around 24. So we're right in line to possibly in another bull market run. Now, I don't want to get back into all that I talked about last time. Certainly happy to carry on that conversation in the Q&A or personally after this meeting. But there's some real argument that we could be entering another bull market. But we got to get past COVID, right? Let's price below similar companies in its industry. So maybe it's underloved, underappreciated. Maybe it has a product line that's not fully developed or not up to par, up to speed with what's out there today. And we carry somewhat less of volatility than the broader market. I think this is really interesting. Not that you can't lose with value. Of course you can. Let's look at the financials, industrials. They're still quite a lot, down quite a bit. But when you have investments that have appreciated a lot, think about it. Is your risk gone up? And the answer is yes. The risk has gone up for you. Has the risk gone up in investments, all things being equal, in maybe those underloved, underappreciated value names? In some situations, yeah, but all things being equal, the answer is no. And that's sometimes a little challenging to wrap our heads around because we think that things go up are going to go up forever. Things that go down are what? Going to go down forever. And we know just investing in the investment market, it just doesn't work out that way. All right. So what do we do with growth and value? And let's think about it from a historical standpoint. And I didn't throw out every matrix that I could throw out to you today, but we basically are laying out what's really worked. No argument here. It's been growth. Growth has powered the performance in most of your portfolios. It has certainly not been the value trade, but value tends to outperform growth as we're moving into a better economic period. So let's think about that. Should we have growth or value? I don't think it's a trade of one or the other. I think it just could be a good diversification. So think about it this way. If you've done really well with some of your growth stock, the really in trade, right? The COVID positive, the stay at home trade, and you've done really well, pay yourself. Remember, you don't make money until you lock in the gains. Pay yourself a little bit. Doesn't mean you got to completely get out of them. That's never the best trade either, trying to time the market. But maybe you lower your exposure and you shift some over to the underloved, underappreciated value area. What would be some examples of that? It could be financials, industrials. Those could be some areas that I'm a little more interested in than, let's say, energy, the old school fossil fuels. Certainly not excited about that area, but I think there's argument to be made that could be a value area or what's called a value trap area. All right. It looks like a great value, but it's just bad performing companies and bad performing stocks. That's what we don't want. All right. And sometimes it might take, while your growth is outperforming, it might take a little time for these values to outperform. That's okay. We're not all needing all of our money tomorrow. And if you do, you probably don't need to be in these areas to begin with. All right. So what should we do? Let's think about a good balanced approach. I know we preach it. We talk to everyone all the time. I know that's how we plan the portfolio. We try to plan ahead for these things, but adjustments and changes need to be made. The outperformance this year and growth has been so out or uncharacteristic over the averages. It's really time to think about making sure you're diversifying your portfolio. I know for most of you, we've already had that conversation. And for some, maybe we haven't. Reach out to us. We want to have that conversation. It needs to be a part of a plan that you have in place. It needs to be a part of a good diversification and great allocation in the portfolio. And when you have all those components in place, you really can weather whatever happens. A pandemic that we haven't seen in 100 years, certainly an election that will probably be contested in some form or fashion. All right. So let's go ahead and move into a little question and answer. If you could, in that section, go under the Q&A section, type that in. I'll let Jeremy jump in right now.
Thanks, Graham. Yeah, so like Graham said, if you do have a question, please type it in the Q&A section of the chat box there, and we'll give you a minute or two, and we'll answer any questions that come up.
Please feel free to ask any question, not necessarily on the topics today, and we'll cover some of those.
Graham, I don't see any coming in there.
I do have a couple that I am receiving, and it says, are the markets going lower? Yes and no. I think that's a reasonable assumption that as we are, not even a week out, 5 days out, the election day, this is the most volatile period in the market. So I think we have to expect that, the market could go lower before it goes higher. If the election is contested, sure, I think we can still expect more volatility, but you should be expecting that volatility anyways. It shouldn't be one of those run for the hills or make big bets in one area or not. Listen, I know it's not comfortable. We hate to go through these types of corrections, but think about it. These things are good. They're healthy. They flush out the things that are overpriced. They get you to start thinking about things that you should be in from a diversification or allocation standpoint. And sometimes these are just good, healthy things that we need to be moving into. I feel pretty comfortable that as we move past the election, that's going to be one question mark that's behind us. Now it's going to be moving on to stimulus. I think that we could be setting ourselves up for that to be passed. I don't know when. These are politicians, and that's always a big question. And then COVID. Well, I think a vaccine is great, but a treatment's going to be better. I think you all know how I feel about that. Again, vaccine is good, but a treatment's going to be better. So I think we could see the market have some legs under it as we move late into the fall, into winter, which is traditionally a very good time in the market. Early fall, late summer is traditionally a very poor time in the market. And that doesn't matter if we're in the middle of a pandemic, an election. That's just traditionally how it is. All right. Let's see. We have some other questions.
Yeah, Graham, Mr. Rick asked, does selling losers to offset gain only apply to taxable accounts and not IRAs?
Great question. Yes, it only applies to taxable accounts and not your 401k, not your IRAs, not your Roth accounts, 457s, 403bs, all these tax deferred or tax-free retirement accounts, only to your taxable accounts. That's an excellent question. But keep in mind, you could sell, let's say, for example, this is just an example. You could sell the UPS and buy the FedEx. I'm not saying that's a recommendation. I'm just using it as a comparison. You could buy, let's say, sell Norfolk Southern and buy the transportation ETF and still have exposure and avoid the wash sale with your loss. So there's many ways to still have exposure to take losses and offset the gains. That's a great question.
Graham, we had another one for Mr. Richard Horler. He said, do you think the market for 2021 will go over 30,000?
I don't know. There's no crystal ball in this, but I look at it this way. And Richard, I know we spoke in our office the other day, and if you're on the Lunch and Learn call, we talked about could we be entering another bull market, and I think there's real fundamental reasons to say we could, but that is going to depend on how well we manage the COVID crisis. Are we going to fully shut down? The economy going to shut down again? My general answer is no. I don't think so, but it's my opinion. I know we're seeing some effects in Chicago with the bars, restaurants, gyms, the non-essentials. I know we're seeing some things overseas in Europe. So I wouldn't be surprised it might be in certain areas. But I think if we can avoid that, I think we could really be setting ourselves up for some reasonably good times moving forward.
And we had another one, Graham. It says, so after you reach 72, you have to make the RMD by the end of that year. And then what will you do? Reinvest?
Yeah. So if I heard the question right, if you take the RMD, yeah, you can reinvest it. If you don't have earned income, you're not going to be able to add it to another retirement account. But you could, if you don't have an individual taxable account or a joint taxable account with a partner or a loved one, then where you can just reinvest that in, you just have to take the distribution.
Okay. And then the last one we have here says, will tech stocks go down with the potential government regulations for Twitter, Facebook, et cetera?
I think that's a big question mark. But think about it. Are the sum of the parts greater than the whole? And I think the argument is, I think some of these tech stocks, even if they did get broken up, they might be worth more in pieces than they're worth as a whole. So hopefully that hits home and makes sense a little bit to you. And then I can always reach out and cover that in a little more detail. But I think it's definitely headline risk, which is news risk. Headline risk on the stock, the valuation are already stretched for the most part anyway. I think anything can put pressure on those. So that's why early on I've encouraged, and I know we've reached out to pretty much everyone in our client base and encouraged, pay yourself, take profit from these things that have done so well. Let's say the tech trade. Make sure you take some profits, you diversify out in some areas that are underloved, underappreciated, or heck, you just built up your cash position for whatever need that you need right now. If it's monthly distributions to cover your income needs, if it's for putting money down on a down payment of a house, or putting Johnny or Mary into college, whatever it might be, let's don't get too greedy in a market that's telling you it's okay to take a little bit of profits.
Graham, I don't have any other questions at this time.
Well, listen, I want to thank everyone for being on the call. Awesome questions. I know there's still questions out there of what this is going to look like going forward, but we're here for you. Again, always email us. If there are some timely topics that you want us to cover, email them over. Let us know what you think or what you want covered, and we'll take it, kind of the majority there, and I'll try to spend some time covering it. But I know growth and value seem to be a topic that everyone wanted a little more information on, as well as we're approaching end of the year, some tax tips. So again, I hope everyone is safe and healthy, and I know we'll be speaking and seeing you soon.